meeting.
Mr. Mayor,
Hey, sir.
how's everything?
Super
Mr. Mayor,
fantastic.
how you doing?
It's all about the Cowboys.
Hey, you better know it.
All right. Tell them again now.
All about the Cowboys.
All about the Cowboys?
Yes.
You do realize that, don't you?
You know what, man? Shake my head.
72. We on the way.
Thank you. You good?
Madam Clerk,
Yes, sir.
I'm going to be absent in just a second, and the Mayor Pro Tem is going to be acting in my stead.
Oh, okay.
Okay?
You heard them, Ms. Bowman?
I hear you.
You heard? Keep it straight.
I am.
Okay.
Done every kind of meeting except one of these pension meetings. But I guess I'll be okay.
You will.
Yeah, you want with them baby meetings, don't you?
Okay. Attorney McLean, I'll ask you if you can go ahead and come on over and approach. Yep. I know that you're sitting in, so yeah, please come on over. You're fine, Commissioner. Yeah, absolutely. You can be here. You certainly can be a part of the meeting. Absolutely. All right. Madam Clerk, it's going to be a rowdy day. It's going to be a rowdy day. Rowdy doesn't mean bad. It means-
Rowdy?
yeah, rowdy, boisterous. Now, had I said cantankerous, that'd be a little different.
Have you prophesied that, or are you prophesying, or you? I would rather you prophesied different direction. How about that?
Well, today is going to be filled with business,
Okay.
blessing, favor,
Okay. Yeah,
all that God has in store for us.
that's right.
We're going to see the implications of that.
Yeah.
The prophet is the index finger on the hand to those that are interested, the pointing finger. And today is a day that we'll point out that Augusta is a resilient and a sustainable city.
Mm-hmm.
Today is the
See,
day
that's
that
what
we'll
I'm
adopt a
talking about.
budget that's almost $1 billion.
Mm-hmm.
Today is a day that nothing but good shall come to thee. Amen.
Amen. I received that one.
All right. All right. All right.
Yeah.
Yeah. Yeah.
Yeah.
All right. In fact, I'll go a step further. We have the power to declare,
That's right.
but then we go beyond declaring to decreeing a thing. And so it shall be established for us.
Right?
That's right.
Yeah, we got
That's
it.
right. Yeah. And no, we're not proselytizing. We're just speaking truth.
Thank you.
Yeah, we're not proselytizing. We're just speaking truth. All right, we'll call this meeting in order. Chair is going to recognize Madam Clerk to read the agenda for us,
Okay.
and then I'm going to turn it over into the hands of the Mayor Pro Tem.
Okay. Our first item today will be a presentation of the third quarter ending September 30th, 2021 investment reports for 1945 and 1949 pension plans, along with the October 2021 update. Heather Siegler from Morgan Stanley will make the presentation.
Let me turn on my mic. Good morning.
Good morning.
Good morning, good afternoon, whatever. It's in your hands.
Thank you so much. Thank you for having me, number one. Everyone should have a paper copy as well as it's going to be on the screen for our presentation. Going to go through, give you an update, talk about a little bit about the markets, talk about what happened throughout the third quarter, talk about what happened for the performance of your pension funds through the third quarter, and then give you an update through October. We're very excited to give you some good numbers. So if we look here, we're looking on page 2 of the report. If we just talk about the market overall, the S&P 500 continued to move higher in the third quarter of 2021, really reporting the sixth quarter of consecutive positive quarterly returns. The index gained, if you look on the page there, you have page 2.58% for the quarter, and that's following the second quarter, which had a record gain of 6.8%. And so while the end of the quarter we saw a little bit of volatility, market kind of peaked out in August. September we had a little bit of a pullback. The index actually fell about 5% and through the end of September, coming off those all-time highs. But the recovery has continued really as the economic reopening process has moved forward. The headwinds we faced, we had the Delta variant cases had kind of worked through in the quarter. We started to see those slow. We also saw labor markets beginning to strengthen, and there were some international kind of unsettlements with some Chinese regulatory issues that kind of were overhanging the markets there. When you look at the overall market, I mentioned to you what the S&P 500 was for the quarter. If you look here, you can also see the mid-cap index, which are your mid-sized companies in the U.S. We're actually negative in the quarter, down 0.93%. We have the Russell 2000 index, which were your smallest companies in the U.S., down 4.36% in the quarter. And if you look on the bottom side, you can see on the sector performance, the best performing sector in the quarter was financials, while the worst performing sector was industrials. If we look at the next page, just give you a broad picture on where we were with the international markets. Looking at the MSCI EFA index, that's your developed international, down 4.45% for the quarter. The emerging markets really seemed to suffer, and they were down 7.9%. That was really because of the overhanging Chinese regulatory issues that we had that were in play at that point. Next page just gives you a look at the overall fixed income markets. If you look at the fixed income, we really look at the Barclays Capital Aggregate Index. For the quarter, it was positive 0.05%. We did have, if a lot of that's been hoping the markets just look for what we believe will be higher interest rates going forward. And one of the things that we were waiting for was earlier this month, the Fed actually did announce that they were going to taper their bond buyback program by about $15 billion a month. And so right now, currently for the month of October, they bought back $120 billion. In November, they're going to reduce that to $105 billion, and then in December down to $90 billion. The expectation is that buyback program will be completed around June of next year. And there's a lot of questions right now about when the first Fed increase for interest rates will happen. Originally, the market was kind of pricing in one increase for 2022, and the numbers out this morning are that we may be 2023 before we see that first increase. So those numbers are fluctuating. It's really data dependent in where the market goes, where inflation moves at that point as well, because we did see, even though we're talking about September numbers, October numbers for inflation, we were around, CPI was right at 6.2%, so we are seeing inflation starting to peak. Employment numbers, through the month of September, we were at 4.8% unemployment. That's your seasonally adjusted numbers. I did just see the October numbers had come out, and the estimate is that those are going to be at 4.6%. So we have continued to see that labor market strengthen. If we take a look at the 1949 pension plan, if we look at the quarterly data, we can see that the quarterly gain for the portfolio was $56,618. But if you look over to the right-hand side, you can see that we began the beginning of the fiscal year with $74,873,434. We have had net contributions or withdrawals out to pay benefits of $1,716,892 and a year-to-date investment gain of just over $7,014,000. And so when we take a look at that, you can see on the left-hand side at the bottom, it gives you the breakdown of percentages for your assets. And you had currently at the end of the quarter, we had 59.7% in domestic equities. Domestic equities outperformed international, so that was a positive for us. And then we had international at 13.68%, which gave us a total equity exposure of 73.39% in line with the Georgia Code. So we are staying in line with that investment policy. We had fixed income assets at just over 24%, and we always keep cash on hand because we do transfer monthly to pay benefits, so we had 2.44% in cash. Our next page just gives it a look at the performance. You can see from your page you have the large cap value manager. For the quarter, positive 2.23%, but for the fiscal year, up 15.3%. 15.37%, right in line with their index. We had your large cap core manager for the quarter up 0.49%, and then for the fiscal year up 15.3%, in line with their benchmark. Then we have MDT, your all cap course, that's going to give you large, mid, and small size companies. For the quarter up 0.83%, or fiscal year to date 16.77%, and they were ahead of their benchmark. We have your two international managers that we have. Lazard, which is your more developed international, more value, and there for the quarter to date, they were actually down 0.89%, but positive for the fiscal year, up 4.18%. Trailed their benchmark a little bit, but they do tend to have a little bit more of a higher quality tilt, and so we would expect to see that when we see some more growthier names start to rally. Thornburg, for the quarter, down 4.01%. They do have a little more emerging market exposure. We don't have that in Lazard, but we do have that in Thornburg. Small percentage, but we do have some there. But for the fiscal year, still positive 3.13%. Next page just gives you a look at your fixed income manager, positive for the quarter, 0.4%, but as we've seen those interest rates move throughout the year, they are negative for the fiscal year, down 0.56%. So the total of all those managers combined give you a weighted return with your cash. For the quarter, we're positive 0.20%. Not terribly exciting coming off of the last quarter that we had, but that brings us for a fiscal year up 9.79%. So well ahead of your actuarial assumption so far this year. And even better when we look at our October numbers. And so that just gives you a historical look at cash flow. But if we look at the October update, you can see on page 9, so through October, we're actually at 14.3% for the 1949 plan, so we're very excited for that. Any questions on the 49 plan before I move to the 45 plan?
If you go to page 8,
Yes, sir?
I'm kind of new to this committee, so I may be a little, whatever. So, in the red, is that a loss?
The red is the cash flow out that we've transferred out of the pension fund to pay for benefits. And so we're on a negative cash flow because this is a mature pension plan. So really good question, but we're always transfer more out on an annual basis than we receive in because we're paying out more benefits than anyone's coming in because of the lower numbers of workers.
Okay, so those are benefits going.
That's right. Yes, sir. Okay. Move on to the 45 plan. On page 10, you can see that we began the year on the right-hand top side for the market value at $5,708,000. We had net contributions that transferred out to pay benefits of $171,559. Positive gain for the quarter of $22,922, but for the fiscal year, investment gain of $446,990, which brought us to an ending market value of $5,983,948. On the bottom left-hand side, you can see there the breakdown by assets. We had total equity of 54.49%. The 45 plan is considered a small plan, so we do not have international exposure here because that's not allowed by Georgia code. And so that's all domestic assets. We do have fixed income. We're going to have a higher percentage there at 41.68%, and cash on hand at 3.8% to pay benefits. Similar performance of managers, because we have the same manager lineup except for the international. So I'll go through those, just kind of give you the fiscal year updates on each of the plans. And so if you look at the large cap value manager, fiscal year of 15.79%, positive 0.39 for the quarter. Large cap core manager, positive 0.45% for the quarter, and fiscal year up 15.2. Your all cap core manager, your large, mid, and small manager up 0.85 for the quarter, but for the fiscal year up 16.8%. Fixed income manager down for the fiscal year at negative 0.52, but positive for the quarter on 0.40%. So that brings us the total with cash for the fiscal year for the 45 plan, positive 8.18%. And if we look at that same information I provided you there, cash flow, this is, of course, even a more mature plan. And then we have your October update. And so for the total fund for October, we're positive 11.7% currently for the 1945 plan. Again, ahead of the actuarial assumption for the year. Any questions on the 1945 plan? Okay.
receive his information.
Who was that second that? You did, Mayor Pro Tem? No.
But Dennis Williams, you're on the committee, right?
Yes.
So you can say.
Yes, sir.
Yeah.
Thank you.
Okay. Thank you. For
DW.
So we need to take a vote, correct?
Yes, sir.
All right. Are we doing?
We gonna, no, sir, we raising hands.
So you want to just call or just raise hands?
Yeah.
All right. So all in favor, raise your hand.
So Mr. Williams, well, this is the pension committee.
Right. right.
Okay, the pension committee consists of the Mayor Pro Tem, Mr. Dennis Williams, Ms. Donna Williams, and Mr. Odie Donald. The mayor's absent, so the motion carries with the mayor out.
Yes, ma'am.
Thank you very much. I appreciate your time today. Look forward to seeing you next year.
I did a good job on that one.
You really did. Item number 2, sir.
Item number 2.
Okay. Item number 2 is a presentation of the actuarial reports from the GMEPS 1 and GMEPS 2 Planning and Zoning Pension Plans. Ms. Jeanette Cooper, Siegel, and Michelle Warner from GMA. We have one more.
Okay, I think I can handle it. Okay, thank you.
Follow you, please.
Here you go.
Thank you, man. Appreciate it. Okay.
Yeah, I can hand them out.
Is it too heavy?
You need one too? You good? You need one?
Oh, no.
Okay.
Just about
Thank you, man.
Trying to get there. Thank you. Okay.
Good afternoon.
Good afternoon.
All right, you may proceed.
Thank you. I'm Jeanette Cooper. I'm with Siegel. I brought one of my colleagues along with me today. Kim Cunningham is with me, as well as Michelle Warner from GMA. And we're here today to present the July 1st, 2021 actuarial valuations for both the Augusta Retirement Plan and the Augusta GMEBS Plan 2. So our agenda, we're going to go through a summary of the results, a little bit on the history, go over a few of the more pertinent plan provisions, and we show some projections for the main plan. For the smaller plan, we just show the summary of the key valuation results and some history and a little bit on the provisions. So, turning to this next page, it's page 3 in your book. We value the valuation date is July 1st of 2021, but bear in mind that we collect both participant data and assets as of March 31st. So when we're looking at asset returns, we're looking at what occurred between March 31st of 2020 and March 31st of 2021. Now, I don't believe we were able to come last year to do a formal presentation, but if we had come last year, we would have told you that last year your market returns, and again, their estimates were around -6%, -7%. That was the range going on. This year they bounced back, more than bounced back, with a 45%, roughly 45% return for each of these plans. When we do your funding, though, we use what's called a smooth actuarial value of assets, which is roughly equivalent to taking your gains and losses and amortizing them over a 10-year period. So when we talk about last year, what the returns are, when we talked about last year where it was like a -6% to -7%, your returns when we smoothed it over were more like a +6%. This year, when we're doing the 45% market return, your return is a positive 9.4%, and there is going to be some more positivity coming in the future. So taking that down, let's just look at the results. Your recommended contribution went up by around 8%, from 8.1 million to 8.8 million. That is in line with the fact that your payroll went up around close to 6%, going from 107.7 million up to 113.8 million. As a percentage of payroll, the results are really right in line. There was a 0.16% increase, going from 7.44% of payroll to 7.6% of payroll. Anything that's less than 2% is generally in line, and we don't really do further analysis, especially as to what the reasons are. But you can see that the numbers are very close. The state minimum, which is an absolute minimum, that you have to put at least that amount of money in per Georgia law, that went from 6.7 million to close to 7 million, a little over 7 million. And as a percent of payroll, again, very similar between last year and this year. Looking at your funded percentages, and this is really where the story of smoothing comes in, you can see that using that smoothed actuarial value of assets, your funded percentage increased slightly from 78.8% to 79.6%. But when we look at the market value, it's a much bigger difference. Last year you were just under 70%. This year you're just below 93%. So going to the next slide, here is some history, and you can see that we're showing the funded percentages over the last 10 years and the recommended contribution rates, and they really have been, for the most part, fairly stable. And you can see the funded percentage, hovering between a low of 77% and a high of 92%. If we were to look at the last 3 years on a market value basis, which we're not showing on this chart, but the last 3 years, 3 years ago, your funded percentage would have been around 83%, last year around 70%, and this year 93%. So it explains that. And you can see that your active population has grown for the most part, but again, modest growth over the period. A little bit about your assumptions. This is just the newest group, the people who are coming in. You have obviously different assumptions for different groups of people over time. Most people are getting an annual cost of living adjustment on their benefits once they retire of 1.5% per year. You have a 2% accrual rate. Just a reminder that normal retirement's at age 65, but people can retire early. If they're general employees, 62 with 25 years of service. If they're in public safety, 55 with 25 years of service. Employee contributions at 6.25%. 100% vesting after 5 years. We also run some projections, and this is assuming a steady state, so we're going to assume that our actuarial assumption of 7.375% interest is earned in every future year, and this would show you if all assumptions, including how we expect salaries to grow, when we expect people to retire, all these demographic assumptions and investment return assumptions played out as we assume, this is what's showing what the contribution rate would look like. It's going to go down over the next 15 years or so, and then it would turn into a steady state. So right now you have some unfunded liability, and once that is paid off, it would be basically a steady state as a percentage of payroll. It would grow a little bit as a dollar amount, but as a percentage of payroll would stay fairly level. This is the contribution rate. Looking at this next slide, which is the contribution amount, you see that it goes down as you pay off the unfunded liability, and then once that's paid off, it's growing with inflation. Lastly, we show you the funded percentage, and again, once the unfunded liability is paid off, you're hovering around 100%. So that's the Augusta retirement plan. Any questions on this plan before we turn to the Augusta GMEBS Plan 2?
You okay? Mr. Williams, you okay?
Okay. So this plan, you can see there was a significant drop in the recommended contribution between last year and this year. And that's because this year the plan is fully funded, meaning that the liabilities are less than the market value of assets. Once that happens, you're basically paying administrative expenses. Last year, when we had those low returns, The negative returns, you actually, if you would look 2 years ago, you were fully funded and you were paying administrative expenses. Last year, when you had the negative return, you had popped out of full funding, and so the recommended contribution went up somewhat. This year, it is back down to the plan being fully funded. State minimum this year is 0. Last year, it was, $29,000. If we look at using the smoothed actuarial value of assets, it actually went from 94.3% to 111%. And you may say that's a fairly big jump. And the reason for that is that although it's smoothed, there is a limit where the actuarial value of assets, we actually keep that for this plan, I believe, within a certain percentage of the market. This one may be 10 or 20% of market, and we keep it fairly close. So I think it's within, so we have it close, and so therefore the smooth actuarial value of assets is limited by that corridor. On the market value of assets, you see a more dramatic jump from 85% funded last year to 123% this year. You continue at this point, you have just one active participant left in the plan, and the other participants, which I think there may be 9 of, are all either in pay status or have already, are waiting to collect. And so you can see on this next page on the valuation history, you can see that your number of active employees over the last 10 years has dropped from 6 to 1, and that's because the plan had been closed. I think we show it on this next slide. Plan had been closed to new entrants effective August 1st, 2006. And so you can see again here what the funded percentages look like, and they've, for the most part, the plan has been pretty much fully funded in every year except for last year over the last 10 years or so. A little bit about this plan. I mean, the main thing here is that the plan is closed to new entrants. This plan does not provide any cost of living adjustments, so the benefits are flat from year to year. And then this is just a little bit of caveats about our assumptions. When we show you the projections, again, we're not showing you the impact if we were to have different market returns than the assumed going into the future. Questions on either of the plans? Okay. Thank you for having us here today.
All right, we have a motion and a second, Ms. Bonner.
Okay, Mr. Bobby Williams. Receive it without objection then? Can we do that?
We can do that.
Okay. All right.
Thank you.
The item number 3 is a motion to approve the restated adoption agreement and addendum to the Augusta, Georgia Municipal Association 401A Defined Contribution Plan. Attorney Zena McLean will make this presentation.
Good afternoon.
And let me just say this. For those of the commissioners who have your agenda books with you, the supporting documentation for Attorney McLean's, you'll find it under item number 31, under the regular agenda, in your agenda books. Okay.
Okay.
Okay, they have.
Good afternoon, Mr. Chair.
Ms. Attorney, can you?
Okay,
Thank
good
you.
afternoon, Mr. Chair and members of the committee. Augusta, Georgia previously adopted the GMA's 401A DC plan, which is comprised of the master plan document, adoption agreement, and addendum. Recently, GMA restated its DC plan and received a favorable determination letter from the IRS. To complete the process, it's necessary that Augusta restate its DC plan documents. The documents contained in your packets will accomplish this action. Using the restated adoption agreement and addendum forms, which have been drafted to reflect the benefit design currently in place under Augusta's DC plan. Essentially, the amended and restated adoption agreement provides that Augusta makes non-matching employer contributions in the amount of 2% of compensation per participant each payroll period. The addendum requires participants to make employee contributions in the amount of 4% of compensation per payroll period. The adoption agreement and addendum have been updated to officially close out the DC plan, defined contribution plan, to new entrants effective October 1st, 2021, and to officially remove the choice between the defined contribution plan and the defined benefit plan. Any questions?
So is there anything we need to do to move forward?
You need to approve.
We need to approve it?
Mm-hmm.
So can I get a motion to that effect?
Motion to approve. Second.
We got a motion and a second. You want us to raise hands, Ms. Bonner?
I'll call you. Mayor Pro Tem,
Yes, ma'am.
Ms. Donna Williams,
Yes, ma'am.
Mr. Dennis Williams,
Yes, ma'am.
Mr. Odie Donald. That motion carries with the mayor out.
Okay, is there any other business?
No, sir, that's it for us.
So we're just waiting for the meeting.
Yes, sir.
All right.